everyone, Tracy Fisher with Marketplace Sotheby's International Realty. Thanks for joining in today. Just with the state of everything changing in the real estate industry and particularly with the mortgage market, I wanted to just record this session with Lynda Myrick with Caliber Home Loans. Lynda, thanks for joining in today. It is Monday, April 6th. We are going to be continuing to keep you updated as things change. Sometimes they change every 45 minutes. Sometimes they change once a week. It's really anyone's guess at this point. So as of today, 3:11 p.m. on April 6th, here's the latest that we have in information. So with that, Lynda is an established lender with Caliber Home Loans. We've done numerous transactions together, and she's an amazing rock star. So thought it'd be really important. She just got debriefed earlier this afternoon on what's happening in our market right now, particularly with regard to mortgages and loans and interest rates. So we're going to unpack all of that here for you today. So Lynda, thanks so much.
Thank you. Thanks for having me.
Yeah, absolutely. So let's just dive right in. So let's start with interest rates. Are these, is this kind of the landscape of low 3 interest rates, or have things changed for us?
Yes and no, and this is not to be vague whatsoever. So if we look at interest rates, end of February, mid to end of February, we were in the low 3% range. To understand, it's so complicated, but I'm going to try to break this down. So how mortgage rates typically work is they follow trading in the bond market. So to simplify it, we have stocks, we have bonds. So the more investors purchase bonds or mortgage-backed securities, the lower the interest rates are. So in a normal market, when investors are selling off stocks, they're buying more bonds and our interest rates fall. So that's what happened at the beginning of the coronavirus pandemic, when things started to kind of trickle in February, when there were concerns about the virus before we knew the full scope of it. The stock market started to plummet and, bonds went up and rates went down. Well, that's what should be happening right now, but what's happening is so different, and it's important to understand where a loan servicer falls into that picture. So it's a lot of information, so bear with me. So you have a loan servicer, and the servicer is whom you make the payment to. So I'm going to use Caliber as an example because we service most of our loans. Not all lenders service their loans. We're unique in that we are a mortgage company and we also do the servicing. But that does not mean that we own the paper. So meaning the paper, we're talking about that particular loan. It's for a conforming loan, and that is a loan amount nationally of $510,000, $400,000. Okay, that's not your sales price, that's the loan amount. So it's the national conforming level. There are areas in the country deemed high balance, and big surprise, Kingston, Homish, and Pierce are considered high balance, or high cost, excuse me. And so that loan amount cap is $741,750. So I just, distinction up in the beginning so that we can kind of have an understanding. So those loans are owned by Fannie Mae and Freddie Mac. And so Caliber is the servicer. In order to be the servicer of those loans, the servicer will pay 1% or what they call 100 basis points to purchase the right to service that loan. In return, they receive 30 basis points or 0.3% annually for the right to service that loan. So that's how they're recouping their money. So if you think about this, that means that they have to hold that paper for at least 3 years in order to recoup that initial investment. So what happens when rates go down? People are refinancing and the loans are being sold. So the servicers are never able to recoup that money. And that's what happens when interest rates just continue to plummet. It's not great for loan servicing. So the next thing that happened is the Federal Reserve lowered the interest rate to 0, right? I have received so many phone calls because it's just not explained what that means.
Right.
The funds rate is different than a mortgage rate. The federal funds rate is the rate in which banks lend to one another, not the same as mortgage rates. So what happens is by them doing that and also injecting billions of dollars into the bond market, their incentive, or what they're trying to do is reduce mortgage rates, but what they're doing is they're flooding the market. So as a result, these mortgage companies, all of us included, and I've got many friends in the industry, I've been in it for over 20 years, and so know a lot of people, and it's pretty much across the board. Interest rates, can we say, inflated over the last month or so, to where literally in one day we were able to offer about 3 and an 8, 3 and a quarter, and then our rate sheet was showing 4.5%. I mean, like literally overnight. And again, this was across the board because I was wondering what was going on, but it's a strategy for companies to kind of get caught up, if you will, and mitigate some of that loss. So what's happening now is that they are starting to, our company in particular, and I can only speak for Caliber because that's where I'm employed, okay?
Right.
So everybody's a little bit different, but we had loans in March that were funded, and so that money was recouped, and so now we're able to realize that, and we're starting to see a strategy of rates coming down again. Okay. So if interest rates were following typical behavior in the bond market, we would be seeing the mid-twos for 30-year fixed, which is crazy because that's not really available as far as I know. And again, I can only speak to what I've researched, and that doesn't mean that someone can't find something online at that rate, but it just doesn't seem possible given the model that I've been talking about.
Okay, so just as a nutshell to kind of reiterate that, so back in February, so they were in the low threes, then they kind of took a false inflation because people were oversaturating the market with refinances because the rates were so low, and now they've kind of started to normalize and steady as people are not refinancing as much because they had taken that spike.
They're expected to normalize as well, too. So, I mean, I believe we're going to see really low interest rates. And I mean, I don't know what that means because, again, I've been doing this over 20 years and I had never seen 3 1/4 before.
Yeah.
So the idea of it going into the twos just seems completely foreign to me. But boy, we're living in times that are completely unprecedented. So
True. Yeah, it'd be interesting to see that. Well, thank you for that explanation. I don't think a lot of America knows exactly how that works. And so it's really helpful when you break it down in that nuts and bolts explanation to show that. So thanks for that. That was really great information.
Resources to figure this out, but yeah, it's very complex.
If bear with us, we're having a little bit of internet bandwidth issues. So if it just hang in there with us. So you brought up a good point earlier in your conversation. You said that this is just what you know as of with Caliber, because there are many different lenders. There's different type of lenders. You have big bank, you have in-house servicers or providers, and then you've got brokers. So Caliber you're your own servicer, correct?
Mm-hmm.
Okay.
We do some loans, but a very small amount, but yes.
Okay. So what changes, or can you explain a little bit about servicing and then what changes you're seeing, with regard to that?
Well, servicing, the role of the servicer is manage the payments of the loan. And so what's interesting to note is that when a customer does not make their mortgage, the servicer is still required to deliver that payment to the investor. Mm-hmm. So if you think about that, that brings up the next topic that you'll probably be asking me about, and that's about the whole forbearance conversation that is occurring. And the government, they've implemented this stimulus package where forbearance sounds very much like forgiveness, but it is not. It's just really important that people understand the potential ramifications of opting for forbearance.
Yeah, you're right. We definitely will be getting to that because I think that's a really important distinction to make. So, but with
I'm sorry, I said bring that back to servicing, Tracy, because for a servicer, they're still required to produce that mortgage payment to the investor, regardless of whether the homeowner provides that payment or not. So think about that. That definitely affects their liquidity, which affects their ability to lend more money to other people.
Gotcha. Okay. So yeah, whether people are making their mortgage payments or not, the servicers are still on the hook to their investors for making those payments. And that's why we're seeing a lot of the changes that are coming down the pike, so to speak.
Right.
So, okay. Well, let's jump into the forbearance conversation because I think that goes hand in hand with servicing. So explain kind of just very briefly, quick, Cliff's Notes version of forbearance and, what's currently being offered and what are the pros and cons of that?
Yeah, so what's being offered is a 3-month, it sounds like a forbearance, not forgiveness. And I bring this up because a mortgage holder can elect to not make their payment for 3 months, and it will not be reported adversely on their credit report. But in month 4, they're required to make all 3 of those payments and the payment for month 4.
And that is the important distinction.
The important thing to note is it is like a balloon payment, and it is due. Now, if month 4 comes around and they're not able to make that payment, could arrangements be made? Mm-hmm. Probably, but eventually those payments are going to have to be made, or it's going to be a situation where it's considered a short sale or something like that. Back to 2008, lived through that one too, but that will affect future credit. And as I mentioned, if interest rates do get into the mid to high 2s, people are probably going to want to consider refinancing. And if you engage in a forbearance, then likely that's going to affect your ability to do that. And understand, please, this is all very, very new, and we're still learning all of this. But yeah. I urge people to really don't just elect to participate in forbearance if you can make a mortgage payment. It's not.
Yeah. So there's 3 important things that I just want to reiterate, because that was a lot of amazing information. And so I just want people to be very, very clear that it's forbearance, not forgiveness. So that those payments will come due. So the government's allowing you to essentially go for 3 months without it being negatively reported on your credit. You can skip up to 3 months worth of mortgage payments. However, that 4th month, all 4 months are due at that time. So it's essentially just a balloon payment. And then if you do go into forbearance and elect to do that, and some people have no choice, some people need to do this, and they just need to understand that if they go this route, that, this is not a forgiveness, this is, a deferment in payment until that 4th month, but then the entire thing's due at that one time. So be sure that you can make that payment all at one time. And then 3rd, I thought was so important is you said you cannot refi. So there's a lot of people where, like you said, interest rates, when this thing finally settles, and it will, let's say interest rates are, at a really optimal rate and people want to take advantage of that. Well, now you can't, because you've elected to go through that. And again, some people have to do this, and it's there as a resource if they need to. But for those people who can make their payments and think, oh, I'm, this is going to be forgiven for the next 3 months, it's not. So just keep that in mind. I think those are super, super important distinctions to make. Okay, so like you mentioned earlier, King, Snohomish counties, we do have a higher dollar, price per, what am I trying to say? Price per home, square foot. Our average price is much higher than the rest of the nation, is what I'm trying to say there. So a lot of our average homes are falling into what you would call the jumbo market. And I know there's been a lot of changes in the jumbo market recently. So can you just very briefly explain what is a jumbo loan and what are those changes that we're seeing as of today?
Sure. So a jumbo loan, now again, it's county specific too, right? So I'm talking King, Snohomish, and Pierce are $741,750 is that high cost area.
Oh, and your mic got muted there just a little bit. Not muted, but it's very quiet. So repeat that again, that amount.
That's strange. Okay, so $741,750 is a loan amount that is still considered conforming in King, Snohomish, and Pierce.
Okay.
Now, if you're purchasing in Skagit, Kitsap, any place else, Whatcom, you need to take a look at, most of those are going to be the national conforming loan limit, which is $510,000. So to your question, dictates what a jumbo loan is. It's anything above that conforming loan limit.
Okay. And because it's really quiet, sorry to interrupt there, because your mic is super quiet, kind of goes in and out. So just to reiterate, so for King and Snohomish counties, a jumbo loan is $741,000 and above. For Skagit, did you say Pierce?
Pierce is in that 741 category.
Okay, so King, Snohomish, Pierce,
but the conforming limit is $510,400.
$510,400 for conforming. Okay, gotcha.
And again, it's loan amount, not sales price. But the main distinction is that those conforming. I don't want to be yelling, but if you can you hear me a little bit better?
It's still pretty quiet. It'll get louder here in just a bit, but keep talking loud if you can for now.
Please, okay. So the conforming loans, they are owned by Fannie Mae or Freddie Mac. And Fannie Mae and Freddie Mac are owned by the government. So that's important because when if somebody does elect to do forbearance, or if they just can't make their payment, then the government's not going to let Fannie or Freddie fail because they own them. So jumbo loans are owned by private investors. They're not owned by the government. So if a customer does not make their payment on a jumbo loan, the harm is much worse than it is on a conforming loan, and that investor is at a very high amount of risk. So jumbo loans have tougher guidelines anyway, and in fact they have reserve requirements, meaning how many months of payments you have in reserve. And the least amount is usually 6 months, some 9, some 12, and they want to document that if you're going to participate in a jumbo loan, that you have this money in reserve, whether it be a retirement account or such, for the event that you can't make your payment. And here we are today. So that's already kind of been incorporated, but that doesn't mean that somebody who has a jumbo loan is going to use their reserves to make the payment, right? I mean, if they don't make the payment, the investor is caught, basically. So that's why many investors are just halting jumbo loans in general. Now, it's still possible to obtain a jumbo loan, but it's going to be very difficult to do so. I know Wells Fargo is a jumbo loan investor that Caliber has used, and a lot of other companies use their product. I know that right now they're offering loans straight to customers, not through channels like Caliber or other lenders. And there's a requirement that consumer must have at least $250,000 in assets with Wells Fargo, because that'll mitigate some of that risk.
Sure.
So the bottom line is, if you're looking at a loan amount and that higher amount, then definitely have that conversation with your loan officer to make sure that your jumbo financing is intact. And that's changing daily too. You know, I mean, you mentioned at the beginning of this that as of today, Monday,
April 6th.
change tomorrow, it could change in 2 hours, really.
Yeah.
And I just try so hard to be as transparent as possible, but we can just deal with the information that we know. We're still trying to assimilate it all. But.
Oh, no, we appreciate that. And I think, we're all having to pivot and adjust on, the information that we're seeing and the protocols that are changing. And, we all just are doing the best that we can with what we have, and, understanding that it does change and it can change day to day. So, but I think, just really, it's great to have these check-ins so that we can understand what is happening in this current market right here, right now, April 6th, 3:30 p.m. Does that change tomorrow? And if it does, guess what? We'll come back at you with another.
It's really you're involved in a transaction, or you're thinking about just kind of like being aware of kind of like things to ask that you might not have thought about asking before, and every time I meet with clients long before this happened, it's kind of know what questions to ask and like what could be a potential red flag, if you will,
That's a good point. So let's talk about how people are personally being affected by this, and especially people who are either in the process of currently going through pre-approval or considering going through pre-approval, because the fact is that people are still buying and selling. Yes, we are taking way more safe measures to do so, but people still need to buy and sell their homes during this time. So there are still people that, are going through the pre-approval process. There are people that are mid-loan as these things are changing day by day. So talk a little bit about, maybe what, just off the top of your head, and if you don't know off the top of your head, that's okay too, but what are some of the questions that you would now ask that you wouldn't necessarily ask before?
Yeah, well, so, the first question we've always asked, the things that go into a loan pre-approval are credit and credit history, employment, income, and monthly debt. And so that debt to income ratio is calculated by the amount of monthly income versus debt. And then there's a formula that tells you how much you qualify for a house payment. So income right now. Well, with the stay-at-home requirement, many people are not able to work. Many people are not earning income. So the main question that I have to ask is, are you employed? Are you making what you made before? Has your income been affected? So that's the main thing. There's many people are fortunate enough to be able to earn their income and work at home, and can I say thank you and a shout out to people on the front lines that are required to actually go to work and expose themselves, but we are safe at home, right?
Yeah.
But somebody that's working, then they're not as much at risk for having a negative outcome from the mortgage. Okay, somebody that is not able to work and in the middle of a transaction, yes, that's going to affect you because we're required to verify employment several times through the transaction under a normal circumstance, and now we're required to do it just up until the very end. And the questions we're asking are, is this employee still employed time? And so that's going to be something that's addressed throughout the process.
So verification of employment will be something that we continue to see up until the second it closes, making sure that that person's still.
If your income's reduced, please don't assume, well, I'm able to go back to work, May 4th, we'll be off of stay at home by then.
Mm-hmm.
So everything's been fine. And if you're closing April 30th, that's going to be an issue. So, I hate to be the bearer of bad news, but that's the absolute truth.
No, it's good. I mean, I think, we need to put this information out there and, we need to be realistic about it. And I think but we don't need to be people burying our heads in the sand. We need to be addressing it and just helping people understand, here's how you could be impacted. It's not everybody. And like you said, everyone's got different levels and thank you so much. You're so right. We honor and are so thankful for the people on the front lines who are putting themselves in front of this day in, day out and risking themselves. So incredibly grateful for that. And it's important to know we're all personally impacted by this in some ways, some in greater ways than others. And I heard a great perspective the other day that I really appreciated because I've heard it and I've said it in the beginning myself, but you say, oh, I'm stuck here at home. And I saw someone say the other day, no, I get to be safe at home. Absolutely. And there are so many other people that don't have that opportunity right now. So thank you to those people for sure. But no, just good information. Anything else in terms of if you're mid-transaction, what to kind of be on the lookout for or how this may impact you?
Just, it I feel like we're kind of keeping up with it, but everything in the industry is a bit strained right now. I mean, it takes longer to accomplish every single facet of the process. So have patience, kindness always, if you're in the middle of the process, I mean, hopefully your loan officer is in full communication with you and giving you that timeline and sharing with you how, you may potentially be affected. But the main thing is, if you are in the process and your income has reduced, please contact your lender. It does. If you're on a furlough situation where you're still earning some income, you still might be okay. But just have that transparent conversation and figure out a game plan.
Okay, thank you so much. So now more than ever, be in contact with your lender. Make sure that your lender is in contact with you, is keeping you updated on these changes. Lynda, I'm going to make sure that we put your contact information on this video so that if people have questions, that they can contact you directly. And again, we just want to be a resource for you during these times. Again, our promise and commitments to continue to keep you updated as we learn more and as things change, which inevitably they will. So thank you so much. I really appreciate your time and your information.
Thank you for having me. I appreciate it.
Absolutely. Okay, well, as always, everyone, keep strong, keep smart, keep safe. Please, everyone, wish you nothing but health and safety during this time. Thanks so much, Lynda.
Thank you, Tracy.
Okay, thanks. Bye.